All right, good afternoon. Good Thursday afternoon, investors and traders. Welcome to Phenom Group's latest State of the Market. I am your host, Seth Golden, and that is your former president, Mr. Abraham Lincoln, who knew well in advance that the internet was going to come, was going to Genesis in the 21st century, and it's pretty awesome that he's that intelligent. Or you're reading the quote as I speak, and you can take from it that you really shouldn't believe everything that you see on the internet. Okay, and as an investor, as a trader, in an environment where the market is in turmoil, as CNBC would like to say, when you have these big moves to the downside, volatility is spiking above 30, we tend to feed on our worst fears and or paranoia, and we look for answers, and we'll look anywhere for them. And the internet is a great place to hunt for solutions that really don't have a problem attached to it. Don't believe everything you read on the internet just because there's a picture with a quote next to it. And here's your picture. Obviously, this is not from Abraham Lincoln. Moral of the story kind of thing. Something that a friend of mine said on Twitter I found just today. If you spend 2 seconds on FinTwit, and you'll see why equities fell 5% in September, rose 10% in October, and then fell 4% again. Overreacting in both directions is what equities do. Set your sails on things like macro, but trim based on psychology, because that's what drives short-term action. When things get too overextended to the upside and too downbeaten to the downside, that's when you should be taking action. When things get overextended, trim your sails. When things are oversold, start to buy up in layers. Social media is a great place to get in trouble, quite frankly, if you're not following the right accounts. And a lot of the information on FinTwit, if you will, which is Twitter, financial Twitter, you got to take with a grain of salt. Speaking of social media and what have you, and since we are in a pretty good drawdown, the reality is we almost had another 5% drawdown. We were 6 points away from another 5% drawdown, at least on an intraday basis, at the start of Thursday's trading session. So far, we've avoided it. I don't know if that's good or bad just yet, because better prices is better opportunity. But for now, we are rebounding here on Thursday. We've seen rebounds in the past and they faded. But when you're in this type of environment, drawdowns are not easy. They're not easy for every investor and trader to stomach. So, maybe, just maybe, this is where you'll be able to determine how much you've grown your emotional quotient over the course of the current bull market, if the drawdowns continue, obviously, in the weeks ahead. Most traders, most investors, as the graphic shows above, most traders do not grow through periods of market drawdowns or downtrends. Most will quit. Most will quit within the first 2 years. 80% will quit. Only 1% of all traders can profit net of fees. 40% trade only for 1 month. All traders start with the dream to get rich quick. It's just coming into the market, becoming an investor or trader with the wrong expectations. Now, a lot of you have seen this graphic before, but it helps to reinforce disciplines and helps for individual traders to reassess where they are. Think about where we started in November, right? We're a month away. In the first week of November, we had a perfect week. Monday through Friday, the market was up. Everything was Dory and hunky, or hunky and Dory. And now we were almost down 5% over the course of the last 23 trading days. How have you performed during that period? Are you panicking? Are you seeking solutions for problems that don't exist in social media, on FinTwit? Or have you learned that these drawdowns are normal and to be expected? I love this pyramid chart as well, upside down period. We talked about this one before, but again, just kind of reinforcing disciplines and maintaining the appropriate approach to dealing with markets in turmoil. The pyramid tells you kind of where you should be spending most of your time. Most of your time you should be expressing patience, reviewing your risk management. The least of your time should be spent doing technical analysis. What do you find on Twitter? It's mostly charts. Easy to absorb, looking at lines on the chart, pattern recognition. The market is a proving ground. It's only a matter of time as to when the market will force you to better recognize the difference between skill and luck. One of the things that we've been talking about for several weeks now is that we've been transitioning from an early stage bull market to a mid-cycle. Folks, with this latest drawdown in the S&P 500, and the failed breakout in small caps, the Russell 2000, I think this pretty much certifies we have transitioned. We are now in a mid-cycle bull market. It's very unlikely that small caps, speculative stocks, micro caps, and to a certain degree, some mid-cap stocks are ever going to outperform through the rest of the duration of this bull market. And in that recognition, you got to be better stock pickers going into 2022. All investors are called, but not all will answer the market's call. The overall trend, it does remain bullish, but market internal showing much weakness and churning of late. What does it mean? Get ready to deal with more volatility than you have in the past 20 months. It's part of the mid-cycle transition and the reality that you are now in the mid-cycle of a bull market. So review your trading or your investing plan now and resolve to stick with it. Anything that needs modification to align with the mid-cycle bull market, do it. Have questions? Ask. Send them my way. That's where we are going into 2022. We're in a mid-cycle. The early innings are over. All right, so November sucked. It did not live up to the traditional or the seasonal tendencies that we've discussed in past state of the markets, right? I mean, usually we have that thrust, which we did initially in the first part of November, and we flatlined, which we did, but we actually never had this surge. Into November, we went the other way. Into December, we went the other way. We went down. And the first couple of trading days here, the first trading day of December, we had a nice drawdown as well, 1% on the S&P 500. So the November seasonal tailwind didn't come to pass. November is typically one of the best months of the year for the S&P 500, but maybe those gains, maybe they were pulled forward. Remember, we were up more than 10% in October. Bottom line, seasonality should be understood, but it should also be paired with other forms of quantitative data. It's not a standalone piece of data to guide participation. All right, now this is another review of a piece of quantitative data. Good first 10 months for the S&P 500. So through October, If you're up 20% year to date at the end of October, tend to see continued strength in November in the final 2 months of the year. We have never been down. When you were up more than 20% by the end of October, we had never been down in November until now. So there's always a chance. You know, that's the thing about the data. You lean into it. Even this had a 100% hit rate. One thing you should walk away from, knowing that this was the first time ever with this criterion that November was a down month, something different is happening. You know, there's got to be something out there. It's exogenous. Otherwise, we should have, you know, found the historical trend here. But we didn't. We didn't. First time that we haven't been down. However, don't rule out the party may not be over here in December. And here's the typical path that the S&P 500 takes in the month of December. We tend to start out kind of choppy. Then we have a nice thrust, you know, into the second week of December. But we pretty much give all of that back. This goes back to 1950, by the way. And then from the middle part of December, we regroup, and it's off to the races. Again, this is seasonal tendencies. It's better to pair this with other quantitative data sets. No month is green more often than December. So while November tends to deliver the best return, the positivity rate is actually less at 68% than it is for December. December has a higher percent positivity rate going back to 1950 at 74%. Historically, the S&P 500 index has gained on average 1.5% in December, which is the third best month of the year, only eclipsed by April and November. Having said that, over the last 10 years, December has actually been much weaker on average due to the huge drop in 2018. In 2018, it was just, we spiraled downward right into Christmas Eve, through Christmas Eve. So just keep an open mind, be flexible, take it day by day here in the back, you know, the final month of the trading year. You want to, you know, make sure the gains that you've worked so hard for, you know, that you can reap those at the end of the year, while at the same time setting yourself up to where you want to be to achieve your goals for 2022. There's a lot to consider here at the end of the year. Everybody always thinks, well, it's the end of the year, I can kind of put it on autopilot, no pun intended, Jerome Powell, 2018. But there's still work to do. There's still work to do. All right, so within the context of the recent drawdown in the S&P 500, almost 5%, as I said earlier, the average stock percent decline from the 52-week high has been much worse. After last Friday, right, we were down 2.25% on that day for the S&P 500. The average stock was down 13% from its 52-week high, which is, you know, pretty much on the median. So it felt painful, but given where we were beforehand, it really wasn't that bad. It's also important to understand this statistic on a relative basis. Is the average stock being down 13% that bad? No. No. More than 50% of the time, the average stock is in a double-digit decline. So, you know, when you see, again, when you see stuff like this on Twitter, which is where I captured this from somebody, from Invesco, right? One of the analysts at Invesco. It needs context. It needs context, right? Because when you hear that the average stock is down 13%, you're like, oh my gosh. The reality is more than 50% of the time in a bull market, that's actually correct. It's not ominous. All right. Here's a study from quantifiable edges. Big drops on Friday, right? Big drops on Friday can be interesting. Both the crash of 1929 and 1987 happened on a Monday. Crash of 87 is still remembered by some traders that are active today, of course. But since then, strong Friday sell-offs have commonly been followed by bounces in the following days. Perhaps this is due to the fact that the fear of a crash causes what might otherwise be an ordinary sell-off to become exaggerated on Fridays, right? People don't want to hold over on the weekend, so they do all their selling on Friday. Whatever the reason, the tendency to bounce has been strong after a big sell-off on Friday. So the study above basically defines a strong sell-off as more than 1.5 times the recent 20-day average trading range. So if you had bought, on day one, if you had bought on day one of that sell-off, let's see, the best outcomes rate occur on day 6. So after that big sell-off, it looks like the 6 days later. And here's the thing, when you look at whether it's a day later, 2 days later, 3, 4, 5, 6, up to 10 days, they all have a 60% or 63% or better positivity rate going forward. And this goes all the way back to 1993. Again, that's a 1.5 times move beyond the 20-day trading range. It's a big sell-off. But going out 10 days, most of the time the market is positive. 76% of the time, and the biggest return happens on day 6. The next day, so would be Monday, has the highest percent positivity rate, but a much lesser profit than day 6. Interesting, for tradable bounces, interesting. All right, so don't give up on Santa just yet, as LPL research says. Again, we're up greater than 20% year to date at the end of November. Even though we, lost some ground in November, we were still up some 23, 24% by the end of the month. You tend to continue to see strength. The December return, when you're up more than 20%, 1.7% on average. The median gain is actually better at 1.8%. Could we be down? Yes, 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 and yes. But we are up 73% of occurrences. Again, when you're up greater than 20% through November on the year, on that calendar. It's happened a lot. Sample size is not small. The odds are in our favor that we're going to have a decent bounce, at least maybe 1.7%. All right, this study right here, the market charts, over 95% of stocks were down Tuesday. 95% of S&P 500 stocks, I should say, were down Tuesday. The exact figure was 97%. This has happened 19 times during the past 10 years. Each time this has happened, the index was higher within 20 days. The average return was pretty robust at 3.18%. Means you're usually going to have a significant bounce. Again, you're looking for oversold conditions. 97% of stocks are down. That's throwing the baby out with the bathwater. Now, here's a study we had looked at from back in November. S&P 500 after all-time high streaks ends. And the reasons why I want to bring this back is, again, because we shouldn't lose our touch points with data, with quantitative data that is still in play. And this one is still in play. Recall that in November, the S&P 500 had an 8-day win streak that also occurred with 8 days of closing all-time highs. The streak ended on November 9th, and the S&P 500 closed at 47.01 that day. Since 1928, 8-day win streaks It also had 8 all-time closing highs in a row, has not been an indication of buying exhaustion. You see, we've done it 7 times before since 1928, so your N equals 7. 1 week later, kind of a coin flip, and indeed, we were down. That's the 1 week return. 1 month later, the positivity percent is now 71 at Wednesday's closing value. So yesterday, we closed at 45.13. 45.13. You know, if we're going to live up to the 1 month return, remember, this was the close, 47.01. If we're going to lean into the probabilities here, the market has a big bounce ahead of it. Right? Because there's a 29% chance that we're not going to make this either. And so that, and again, this was November 9th. Basically have until, see what the calendar looks like here. We'll call it the 8th. Wednesday next week, Tuesday, Wednesday next week. That would be a pretty good rally from 45.13 to get to at least 47.02. That would be a pretty good rally. 3 months later, the S&P 500 was always higher after this kind of a win streak. 8 days of new highs and new closing highs. Has never been down 3 months later. So if this doesn't work out, we're still looking at the probability being very high to be above 47.02 out another 2 months. This is the other one. We had a perfect week, the first week of November. We were down this week, which was kind of a coin flip. You know, after you're up 5 days in a row, Monday through Friday is considered a perfect week in the S&P 500. The very next week, we were down. 2 weeks later, we were up by, I think, 6 or 7 points. So we did do it. You know, we did make it. Not by much. And the gains aren't very big anyways. But 1 month later, the percent positivity rate gets even stronger. The return is a little better also. Now, we finished on Friday, November 5th. Right? So it was November 1 through November 5, Monday through Friday, and we finished that day on Friday at 46.97. So 1 month later, from November 5th, again, this is just like the previous study here. It suggests we have a pretty big bounce to anticipate, but we also have to reflect on what happened in November. Something went wrong with November to disrupt that seasonal tendency. Could something disrupt this here and this here? Is there something that is pulling at the market that is that consequential that all of these different quantitative studies will not come to fruition 1 month later? We don't know the answer to that. We can only, time will tell. Time will tell. We'll know next week. That's for sure. We will know next week. Now, this study here from Steve Depp quantitatively analyzes the trading day result from yesterday. And here's the criterion that makes up this study. Let me try and blow it up a little bit here. All right. Here are all the instances where the S&P 500 recorded the following 2-day pattern. Okay, so on Wednesday, it was up 1.5% during the day. Then it gave it all up and it was down 1% or worse at the close, which it was. That's what happened on Wednesday. The prior day had a red close. We were down on Tuesday. So using that criterion, up 1.5%, then finishing in the red by 1%, and the previous day was also down, you get 15 occurrences dating back to 1975 that has happened. So if we go 1 day later, which would be today, the average return up 1.5%, but kind of a coin flip at 57% positivity rate. 2-day return, even better, percent positivity rate is 64%. The 3-day return, again, it gets better at 71%. 4-day return, 78% positivity rate. 5-day return, same thing, 78% positivity rate. It's green across the screen here, or white across the screen here, positive gains. So for all the doji candles and things that you outside reversal days that you've been hearing about that followed an already red day, they tend to deliver positive returns after that. This study goes all the way out to 20 days. All right, here's another one. Buying a pullback in an uptrend. Because as I said earlier, we're still in a bullish uptrend, folks. This is still a bull market despite the VIX going over 32 the other day and almost getting a 5% pullback here. We're still in an uptrend. So let's consider the potential for using a simple breadth-based indicator to play the long side using shares of the SPDR ETF or SPY. We will look for times when the SPY is above its 200-day moving average, and then fewer than 40% of stocks are trading above their 10-day moving averages for the first time in a couple of months. Right? So fewer than 40% of stocks are trading above their 10-day moving average, which tells you we have some kind of a correction going on, some kind of pullback in the short term, right? 10-day moving average. The first condition filters for an objective uptrend, right? The 200-day moving average. The second condition objectively identifies a pullback in the overall index. There's no shortage of signals, folks. A lot of signals. But ultimately, what we want to know is if we buy that pullback, what are the returns potential? Well, this chart basically tells you the growth of $1 invested in the SPDR for 2 months after each pullback in an uptrend, given those conditions that are identified in this chart here. If we bought the SPY after every signal and held for just 2 months, the cumulative hypothetical growth of $1 since 1998 shows you would have done very well. It's a simple buy the dip in an uptrend approach to trading, but it can be consistently profitable over time. Almost a 5% pullback again. So the time and time again, it seems like, right? But I want to nail that down because it sounds kind of odd because we just came from that scenario in September, 2 months ago. Like, is something problematic here with the market? Should you be nervous given that we've almost had another, and we could still potentially have another 5% drawdown? Is there an anomaly here? Especially since we didn't have a 5% drawdown in the first half of the year. Right? And a lot of you remember this study here from Bank of America's research. Right? If you don't have a 5% drawdown in the first half of the year, but then you do have one in the second half of the year, which we had in September, the returns or the drawdowns in Q4 several times. Look, 5% drawdown, 5% drawdown, almost 7% drawdown, almost a 5% drawdown. The average drawdown is 3.87%. Given that criterion of not having a 5% drawdown in the first half of the year, then having one, yeah, you can still have another one in Q4. It's not an anomaly. But don't let that detract from the fact that Q4 returns have been positive 100% of the time since 1959 when you don't have a 5% pullback in the first half of the year and you do have one in the second half of the year. Now, here's the thing. Where were we when we had that 5% drawdown at the end of September, because we just need to be higher than there for the Q4 return to stay perfect for this study. Well, at the end of September, we were just at 4307. So anything above 4307, this study would still be perfect. And right now, of course, we are above 4307. Now, using the median Q4 return of roughly 5%, here's the median return of almost 5%, right? I could use this one, which is almost 6%, the average return for this study. But let's set the bar high for ourselves, meaning it's a lower a lower percentage return. A 5% gain, that would put the S&P 500 from 4307, it would put it at 4522 by year's end, which is where we almost were, basically were coming into today's trading day. It's always, again, sometimes we can misuse these kinds of analytical data sets. All right. Another study we cannot lose sight of, folks, because we get wrapped up. I think investors and traders get, especially active traders, get wrapped up in the moment. It's only the drawdown, the drawdown, the drawdown. That's the focus. And we forget where we came from, how we got to this point in the drawdown. Recall, the S&P 500 advanced decline line broke out. Right? It broke out in November to a new all-time high. The NYSE advanced decline line, new all-time high. The value line geometric index, new all-time high. The mid-cap S&P 500 advanced decline line, new all-time highs. When you get new all-time highs in advanced decline lines, the probability of a 10% drawdown within the next 3 months plunges from a 15% probability to just below 5% probability of getting a full correction, 10%, correction. So that's where we came from. We came from a point where everything was working again. The advanced decline lines had broke out to new all-time highs, validating the indexes being at all-time highs. But in the context of trying to decipher how bad could the current drawdown get from a probabilistic standpoint, there's really only about a 4.6% probability historically that we're going to get a 10% correction. That's how bad it could potentially get. Now, of course, that's a probability. There's, a probability that this shows up and that much more. But this is a very low probability. So what do you need to be doing? You need to, again, consult your game plan. Consult your game plan and, visit your risk tolerance, of course. What we do know is that you want to be buying the dip because your North Star, which is earnings, are still growing. They're still projected to grow out into 2022. What do we also know about these dips that happen in the market? They're fast and they're bought back really quickly, and that's what this chart basically tells us. People say that we're in a low volatility environment, and the reality is, kind of. Right? Because we've actually had more 2 sigma shocks this year, the most that we've had since 2014. This chart we actually posted back in, I think it was either September or August. Since then, we've had 4 more 2 sigma, and 3 of them have happened within the last 5 trading days. We have 14 2 sigma shock days. But it's taken the least amount of time to recover from those moves. And that's why it seems like we had less volatility, because the drawdowns are quick and they're, you know, just as quickly we resume to the upside. For those of you who think, well, you know, I'll wait to buy for a bigger correction. Not a good idea. Not a good idea. It's better. History tells us, and that's what this chart says, it's better to just layer into positions little by little as prices get cheaper during a drawdown. Because the market just doesn't stay in a correction very long. And some years we don't even have a correction. A correction, again, is defined by at least a 10% drawdown from the peak to the trough. 2013, never had a double-digit drawdown. 14, nope. In 15, we only spent 5 days down 10% or more. In 2016, only down 20 days, 10% or more. 2017, didn't happen. 2018, 15 days. And by the way, what do you think your psychology looks like? After waiting all this time for a bigger correction, now you're going to pull the trigger? Now all of a sudden you're risk averse? It just doesn't match, right? It's kind of hard to believe that all of a sudden you're going to be able to pull the trigger. Getting into a habit of just layering in a little bit at a time is the better approach. 2021, again, we just don't. Of course, in 2020, yeah, that was rough, right? That was rough. What do you want to be buying? You know, here in December, here's a great list of stocks that, you know, over the last 10 years, these are the best performing stocks in the month of December. Over the last 10 years. You'll notice something. Banks, financial services, banks, financial services, banks. Let's see, banks. There's a lot of banks and financial stocks in here. JP Morgan is one of them, by the way. KeyBank. Here's the average return in December over the last 10 years and the percent positivity. KeyBank and healthcare equipment service providers, EBH, I'm not familiar with, 90% positivity rate over the last 10 years. The highest return, Eli Lilly, has 5%. WDC, 8.7. What is the return on JP Morgan? 3%. Not bad. Over the last 10 years, you would have done well. And we hear all of it's just constant drumbeat. Don't buy tech. Don't buy tech. Rates are going to rise, right? We've been waiting for yields and rates to rise. And it's an endless narrative that goes nowhere. But the reality is, for those that think that tech stocks don't do well in a rising rate or a rising yield environment, that's not true. Here it is. Technology, rising 10-year yields. Technology versus the S&P 500, technology does slightly better. Falling 10-year yields, technology actually does worse. It actually does worse, and this goes back to 2010. Right? Financial media. You want to be buying tech, especially going into a mid-cycle. In a mid-cycle, you want to own tech. You want to own large cap tech growth. What's not working, what kind of gets jumbled in the whole tech conversation, is unprofitable tech, because there's a lot of unprofitable garbage tech out there. And, you know, it's the low level of the NASDAQ, and that's doing terrible. You want to stay away from that. This is not the type of tech we would buy going forward. Better to stick with strong fundamentals, strong balance sheets, which can be found in large cap tech and growth. And why should you be buying tech? The corporate insiders are buying their own stock. This is the technology sector ETF, the XLK. Corporate insider buys. It's a feast. They're always buying their stock, whether it's Apple or Microsoft, Adobe. They're always buying their stock. Why shouldn't you? I mean, that's where the profits are. These are the companies that go higher in value. These are the stocks that go higher in value over time. The corporate insiders are buying. That's kind of like a green light. What do you need to stay away from? Well, what's been happening in the Russell versus the Spider, or the small caps versus the large caps? Look at the charts, folks. I mean, this was a beautiful breakout, normal, retrenchment here. But this is not. We had a long period of consolidation, then a breakout and a bust really quickly. 15 days. That's all it took, just 2 weeks for the Russell to break back down into the consolidation territory. For me, like, I've seen this before. And to me, this is kind of like the nail in the coffin when it comes to identifying the transition's done. The early innings of the bull market are over. You are in the mid-cycle. Pick good stocks. Not everything's going to work going forward. You need to be in the right areas of the market. Small caps have trailed the S&P 500 now for 12 consecutive trading days. That's the most ever. Again, if you're looking for signals, where are we in this bull market cycle? There's another one for you. A lot of folks right now, they get nervous, down 2% in one day, down another percent, a couple of days later. The VIX is upwards of 30. You say, well, I just want to avoid the market altogether. Well, the thing is, if you're trying to avoid the worst days in the market, more than likely you're going to avoid the best days because they tend to cluster together. If you miss just the 25 strongest days in the market since 1990, the 25 strongest days in the market, you might as well have just been in a 5-year treasury. The gray line is the US 5-year treasury. That's you if you've missed the 25 strongest days in the market since 1990. If you just stayed in for the whole time, this is you up here. If you miss the 25 best days, this is you. This is kind of a buy and hold chart. Just stay in the market. This is you missing 25 days, and then you're basically right with the 5-year treasury note. Just stay in the market, folks. Things are not always peaches and cream. This chart right here also helps us out, recognizing you need to stay in the market. You'll notice a few things. The best days are often followed by the worst days. The red dots are the worst days. Green dots are the best days. They cluster together. Look at that. 2009, the worst and the best days. They're all there together. 2011 was another rough spot. We were down 19% on a closing basis, the European debt, crisis. We had a technical correction intraday. We were down just over 20% at one point in 2011. So yeah, you can try and avoid the worst days in the market, but you're also going to miss the best days. The easiest thing to do is consult with your game plan. Plan for nonsense. Plan for moments like we had last Friday, because they're coming. It's just a matter of when. Plan for drawdowns. The average year, going back to 1980, the average year has 3 separate 5% drawdowns. Plan for it. That being said, hope everybody enjoyed our weekly State of the Market. I'm Seth Golden. Have a great month of December, as I am on vacation, but you know where to reach me.